welcome to the Business Standard Morning Show. I'm Nazia Iqbal, and here's a look at the stories for the day. At the fag end of January this year, when Adani Group stocks were falling like house of cards, heads had started turning towards another highly leveraged conglomerate, Vedanta Resources Limited. But during the last 3 months, both the companies have trimmed their debt and some skepticism too. So can we safely say that Adani and Vedanta have come out of the woods? Tushar Verma and Bhashwar Kumar crunched the numbers and talked to experts to get the answer.
The London-headquartered Vedanta Resources Limited, the parent company of Mumbai-listed mining giant Vedanta Limited, has been trying to assuage investors of its debt burden for a while now. Its debt burden, which came under scanner after the Adani Hindenburg turmoil, seems to be easing now after it paid off all the mature debt of the April month. As on April 2023, Vedanta's debt stands at $6.8 billion, down from $9.7 billion in March last year. The promoters of Vedanta also got 70,444 crore rupees worth of pledged shares released. This is being touted as one of the largest releases in the listed space. According to Group Head Anil Agarwal, the company is well positioned to meet its debt obligations and the concern around being over-leveraged is misplaced. Agarwal has said that the group is expected to make a profit of $9 billion next year on its revenue of $30 billion. The Adani Group, on the other hand, has secured assurances of financial support from 3 Japanese banks, Mitsubishi UFJ Financial Group, Sumitomo Mitsui Banking, and Mizuho Financial Group. The support will aid the group's expansion plans and help refinance and restructure debts. The existing lenders, Standard Chartered and Barclays, have expressed confidence in the group as well. Adani Power's consolidated net profit after tax for Q4 FY23 rose 12.9% to Rs 5,242 crore as compared to Rs 4,645 crore for Q4 FY22. Adani Ports and Special Economic Zone has contributed an impressive 80,732 crore rupees to the coffers of the Customs Department in FY23. This was an increase from 60,945 crore rupees in FY22. The mentioned increase is a result of increased cargo handling capacity at the port. The port company handled 339 million tons of cargo in FY23, which was an increase of 8.6% year-on-year. Do these developments suggest that Adani and Vedanta have turned the corner?
So let us first take Adani issue. The Hindenburg report, when it came out, actually, in my opinion, it was a very big shock to overall Indian capital markets, including Adani in particular. But the way Gautam Adani faced the challenges, he has demonstrated his leadership. He prepaid certain debts. However, because of the capital intensive nature of his industry, challenges remain. He will have to raise the funds again. So we cannot say turnaround, but we can say damage control has been done very well. Now, second thing is Vedanta, and size is a little smaller compared to Adani, but they have also repaid $1 billion now, prepaid. But prepaid doesn't mean that they don't need the funds. And looking into the confidence of Mr. Anil Agrawal, again, management quality matters. So in the past many years, he has proved himself to be a good leader coming out of the difficult situations very well. So industry, especially financiers, trusts the leader. But turnaround in his case too has not happened right now.
Both Vedanta and Adani are heavily invested in capital-intensive sectors. Adani Group's debt rose almost 21% over the past year, whereas Vedanta had accumulated debts of $9.7 billion. But over the past year, both the groups have taken many steps to pare down their debts. Looking at the stock prices, both Vedanta and Adani Group stocks have corrected significantly. Investors can take some time to relook at the finances of these companies before confidence re-emerges.
The London headquartered Vedanta Resources Limited has ambitious plans to set up a $19 billion chip manufacturing plant in Gujarat. This is in partnership with Taiwan's Honhai Precision Industry. However, the joint venture has not yet been finalized because of some compliance holdups. Vedanta is yet to disclose its tech partner for the high precision nanotechnology for chip manufacturing. Not to mention, the company has no prior experience in chip manufacturing as well. Inadequate disclosures might make it difficult for Vedanta to secure 50% funding from the government. The Adani Group, meanwhile, had completed the sale of its Myanmar port business for $30 million following sanctions from the US. The sale dealt a $120 million blow to the group's port business. On top of this, the group is still recovering from the $100 billion loss in market value following the Hindenburg report. What, then, are the challenges faced by the Vedanta and Adani?
Challenges that remain for the groups is more towards bringing the net debt to EBITDA ratio and the debt service coverage ratio within acceptable limits. To do this, the groups would navigate the next few quarters in a way where the capex is generally tapered and cash flows that are generated by the businesses are used towards paying down the debt. Furthermore, they would look to really show the robustness of the underlying businesses by way of superlative quarterly growth in earnings, which would not only help in servicing the debt and achieving a positive and favorable debt service coverage ratio, but it would also help in paring down the net debt at the group level.
While the companies are performing relatively better, experts are skeptical if Adani and Vedanta have completely turned the corner. According to reports, the government is likely to oppose any plan by Hindustan Zinc Limited to buy out parent Vedanta's global zinc business even via a non-cash deal unless the valuation of the assets is brought down to a more realistic level. The Adani Group, on the other hand, has still not recovered its lost market value.
Experts, meanwhile, point out that better planning and foresight may have saved the two big groups the hassle they have just gone through. Moving on, we also need to devise a wise strategy to ensure a hassle-free retirement. The EPFO recently came out with a long-awaited replacement methodology for contribution towards higher EPS pension. But what is it and why are some people still skeptical about it? And will it not add extra burden on the retirement fund body? Tariq Ahmed brings you the answer. On November 4, 2022, the Supreme Court had asked Employees Provident Fund Organization or EPFO to come up with a revised mechanism for those who opt for higher pension. Earlier, employees opting for higher pension had to pay an additional 1.16% on the part of their basic salary, which was above the wage ceiling. Now, over 6 months later, the EPFO has finally come out with the revised mechanism for higher pension. Under it, employees will have to pay only 12% of the actual basic salary and not any additional amount. The EPFO has also extended the deadline to apply for the higher pension to June 26, 2023. At present, out of the basic salary, 8.33% goes into the Employees Pension Scheme or EPS and 3.67% into the EPF. But the employee contribution had a cap of 15,000 rupees. It means only 8.33% of 15,000 can be contributed to EPS and the rest will go to the EPF. Now, the EPFO has removed the 15,000 cap and employees will be able to contribute more to claim higher pension upon retirement.
The whole structure is that the employer as well as the employee both have to contribute 12% towards the provident fund and pension, and 8.33% of the pensionable salary or the threshold, which is 15,000 currently, that goes towards pension funds, and all the balance, that is the employee's contribution of 12% plus the balance of 3.67 of the employer contribution, all of that goes towards provident fund. That is how the division today is, unless an employee has opted for higher pension. If he has opted for contributing towards higher pension, then instead of 8.33% of the pensionable salary, that is 8.33% of 15,000 going towards pension funds, what will go towards pension fund is 8.33% of the basic salary. That is the difference. That is the delta that we are talking about today in light of the Supreme Court decision.
Initially, for the higher pension, employees were supposed to pay an extra 1.16% as the service charge. Now, the latest update says that it will be taken from the employer's contribution, but the higher provision scheme has its pros and cons.
Now, what can happen, right, if you decide to go through with this shift that is now being provided for, money will be shifted from your lump sum employee provident fund account. Money will be shifted into your pension annuity employee pension scheme. So now the advantage you could get is, instead of that money coming to you one time, it now goes into an annuity where, in a periodic fashion, every year in every pension payment, the higher corpus is now there for you. So one benefit could be that now there's more money in employee pension scheme, and you can expect that this will pay you pension for the rest of your life. That's one benefit. However, there's also a con, right? So the EPF employee provident fund lump sum, which was paid after retirement, that was tax exempt. So you are not paying tax on that. But on the pension that you're getting monthly, on that you will pay tax. So there are pros and cons to this. So should you do it or not, right? There is no one-word answer we can give people.
While the employees can opt for the higher pension, it will put pressure on the Social Security Organization. An evaluation that was done in FY17 showed that EPS had a deficit of 15,000 crore rupees, and this number is likely to increase once the pensioners outnumber the fresh joiners. Higher life expectancy of people and lower returns from investments may also add to the woes.
It is not a fixed contribution. Unlike a provident fund, the provident fund is amounts put in by the employee and the employer contribution, and the government's liability is restricted to a annual interest, which is charged on that. So somewhere there is a thought process, or somewhere there is an idea that, okay, this is the amount to be paid. But in case of pension, that becomes really a tricky question, because nobody knows what is the life expectancy of a person or a spouse. So it becomes an unending kind of liability for the government to undertake today.
In principle, we know what's happening. What was a one-time lump sum which was paid in a tax-free manner, money from that can be shifted for a certain equation without a 15,000 cap into your employee pension scheme. That will create a long-term commitment which will go on for the rest of your life, right? Now, whether this is net positive or negative, right? I think a little bit of analysis and some time is required to be able to put that data out.
Another expert related to the matter, Harsh Rungta, points out that whenever the governments world over were burdened by the pension liabilities in the past, they put a cap for the maximum pension payment to control the situation. In the same way, if the government has a huge deficit to fill in the future, the expected higher pension contribution may be in vain for the employees who choose to pay more for a better pension. Let's move on to markets now. Analysts believe that India Inc. could be embarking on a new phase of capex cycle. With capacity utilization at around 75%, orders are streaming in for related companies. At the bourses, shares of capex-related companies have surged in the range of 13 to 41% thus far in 2023. So is there any headroom for more gains? Nikita Vashisht and Puneet Wadhwa answer. The S&P BSE Capital Index has cemented its position as one of the best performing sectors in calendar year 2023 so far. At the bourses, the S&P BSE Capital Goods Index has rallied 12% year to date as compared to the S&P BSE Sensex that has moved up around 1.5% during this period. Other sectoral indices, meanwhile, have given mixed returns varying from -10% to around 9%. Among stocks, Larsen & Toubro hit the 2,400 rupees mark on Tuesday, May 9, rising over 13% so far in calendar year 23. ABB India, Siemens and Polycab India, meanwhile, hit their fresh 52-week highs on May 8th. Analysts say new capex projects and a strong credit growth are driving the rally in these stocks.
Well, the traction has been mainly due to the government's increased allocation to infrastructure in the union budget. The China Plus One strategy had boosted the Atmanirbhar Bharat initiative, which had already played a major catalyst for the growth of the manufacturing sector in India. According to the latest report from RBI, which indicates that capacity utilization levels in the manufacturing sector have approached 75%, which indicates strong momentum going forward. This, coupled with the private sector's efforts to deleverage their balance sheet, has resulted in a surge in order inflows for capital goods companies.
According to a recent note by Jefferies, order flows in the industrial companies have clocked over 15% year-on-year growth from the pre-pandemic lows of 5%. With capacity utilization above historical average, we may be entering a new phase of the capex cycle. Going forward, analysts see more gains in the offing for select stocks.
With this being the pre-election year, order books for infrastructure companies are bound to increase further. This would ultimately get reflected in their financials. Investors should look at stocks which are fundamentally sound and have an excellent completion track record.
So which stocks should be on your radar? Deepak Jasani of HDFC Securities says revenue visibility will be strong for companies involved in new age areas such as EV ecosystem, data centers, wastewater management, warehouse and logistics, defense and smart infra. Jefferies on the other hand expects L&T, Thermax, Siemens, Polycab India, KEI and ABB to outperform. Today on May 11th, investors will react to the US inflation data and await the Bank of England's interest rate decision. Back home, Q4 earnings will guide the sentiment. The stock of Zomato slipped on bourses on May 9th amid reports that government-backed ONDC may hit its business. People are hailing the low prices of food items being offered on ONDC. But there is much more to it. In our Decoded segment, Raghav Agarwal tells more about ONDC.
The Open Network for Digital Commerce, or ONDC, is an initiative by the central government to make e-commerce interoperable and promote an open network to buy and sell goods and services online. Based on the open source methodology, ONDC allows consumers and sellers to be digitally visible and transact through an open network which is independent of any other platform. It gives the customers access to segments like mobility, grocery, food order, and hotel bookings. Launched in April last year, ONDC goes beyond the usual model of digital commerce where the buyer and seller need to use the same platform for a business transaction. The customers can discover any seller, product, or service using any compatible application, giving them a wider choice. They can also get quicker delivery of goods and services as they can shop from the nearest available shops. The shops will not depend upon the platform they are using, as is the case with Amazon and Flipkart. It comes under the ambit of the Department for Promotion of Industry and Internal Trade, DPIIT, under the Ministry of Commerce and Industry. Open source network also comes with concerns about the safety of personal data on the internet. However, the centre has clarified that ONDC will take all measures to ensure the confidentiality and privacy of data in the network. It will also not mandate sharing of any transaction-level data by participants with ONDC. Moreover, it will work with its participants to publish anonymized aggregate metrics on network performance without compromising confidentiality and privacy. The consumers need to visit the website of ONDC and click on Shop on ONDC on the homepage. Then the buyer will be offered a number of platforms where they can buy a particular product. The consumers can select the platform and click on Shop Now. Then just select the items and pay the required amount to place the order. Several users have taken to social media stating that they are being offered food cheaper on ONDC as compared to food delivery platforms like Zomato and Swiggy. According to reports, there are a number of reasons for this. 1. ONDC is currently offering discount coupons of 50 rupees per order for new users. Second, the centre is also subsidizing the delivery amount for its participants, reducing the logistical overhead. Zomato, on the other hand, charges for delivery per kilometer. Swiggy has also started charging platform fees to the tune of 2% of the order value. They are also charging packaging charges, taking the delivery charges up.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The Commerce Ministry compared ONDC with UPI recently, saying as UPI is to the digital payment domain, ONDC is to e-commerce in India. Well, that's all we have for you today. We will be back with more news and analysis in our next episode. Stay tuned. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.